Hi, and welcome back to Investment Banking University's investment banking course. This is video forward. We're discussing finance right now and some of the concepts related to it. So we're going to get back right into the discount rate. An organization's discount rate is the cost of equity and cost of debt together in a model that combines them. This is known as WACC. WACC could be modeled by the cost of equity times the proportion of equity in the capital structure plus the rate of debt tax affected times the debt proportion of the capital structure. In terms of the value of equity is the present value of all future dividends. Sources and uses, uses are cash flows, and sources are WACC and CAPM to get the cost of equity. In terms of accounting statements in the statement of cash flows, the purpose of the statement of cash flows is to explain the increase in the cash accounts in the balance sheet as a function of the firm's operating, investing, and financing activities. In terms of valuation methods, the total enterprise value, or TEV, versus the DCF, which is the discounted cash flows method. In terms of a market valuation, the total enterprise value is equal to market value of equity plus the market value of debt plus preferred minus cash. In terms of a DCF method, or intrinsic value, is equal to the present value of future cash flows discounted at the weighted average cost of capital plus liquid assets. In terms of accounting value versus finance value, accounting value of a firm is a backward-looking and thus incorrect to use in valuation, since we're talking about a perpetuity which is cash flows or benefit stream into the future. Finance value is forward-looking and consistent with the fact that the owner of an organization or security has the claims in the future cash flows of the business. So future cash flow in DCF. Free cash flow for and DCF. Free cash flow calculations is DCF or for DCF. In terms of portfolio analysis in the capital asset pricing model, discount rate is the measure of risk associated with horizon, safety, and liquidity. We get the discount rate by analyzing the distribution of an investment's returns. We get the standard deviation, which is a measure of variance in returns. Standard deviation is a component defining the discount rate, and we do so with a function Excel, which is STD EVP. What does the frequency distribution look like? And that's a question we're asking. And we determine the risk measure known as beta and plug this into CAPM to get the discount rate of equity. We derive the cost of debt and then calculate the weighted average cost of capital to get the discount rate of the firm. So in terms of ex ante versus ex post returns, ex ante is the expected return. Ex post is the actual return. In terms of statistics for portfolios, the Excel functions that we're using are equals average equals VARP to get the variance of returns. To get standard deviation of returns, STD EVP. And to get the covariance between two sets of returns, we're using equal COVAR brackets. To get correlation between two sets of returns, we're doing equals CORREL or coral. The trend line or regression, we click on the points in the XY graph that we generate, and we right-click to add a trend line with linear regression and display equations and the R squared on the chart. And we're going to talk about how to do that and what that ultimately looks like a little bit later on in the course. In terms of portfolio returns and the efficient frontier, statistics are used to determine acceptable and unacceptable portfolios. Diversification lowers standard deviation of the portfolio. Are the returns correlated? If not, then add security to the portfolio, i.e. diversify. The efficient frontier is a set of all portfolios that are on the upward sloping part of the graph, which starting with the minimum variance portfolio, i.e. the market portfolio. Choose the portfolio that is on the efficient frontier is what we're ultimately going to end up doing. The efficient frontier in the optimal portfolio. The best investment portfolio is made up of the risk-free asset and a risky asset representing the market, i.e. the market portfolio. And we determine the market portfolio, the portfolio with the highest attainable Sharpe ratio. Market portfolio is the best combination of risky assets available to the investor. In terms of the security market line and CAPM, the security market line says that the expected return of an asset is a function of the asset's beta, i.e. sensitivity to the market. And the only relevant risk is systematic risk, since the investors will be all diversified. In terms of the security market line and investment performance, the security market line says that the expected return of an asset is a function of the asset's beta, as we discussed. In terms of the security market line and investment performance, the investment performance is associated with the risk-adjusted performance. And the question we're asking is, are there excess returns? Related to risk-adjusted performance, the market portfolio proxy is the S&P 500. And we're going to talk about what a proxy is associated to the market portfolio. Beta is a measure of riskiness of the security. Alpha measures excess return. And then the market portfolio proxy is, of course, S&P 500, as we just mentioned. And so it is about investment performance relative or versus the risk involved in the investment. In terms of CAPM and investment performance, we use CAPM to get the discount rate of equity and compare to cost of financing alternatives. Is there risk-adjusted overperformance or alpha or underperformance? Is performance commensurate with risk? Is what we're asking. In terms of excess returns, excess return is the investment spread over the one-year treasury, the risk-free rate, because we're comparing the investment returns to a different asset that's available for us to purchase, which is the risk-free rate. It's not just measured in isolation. And we use a regression equation to determine if underperformance, negative alpha, or overperformance, positive alpha. When regressing an asset's return against the market portfolio, alpha measures excess returns over the market portfolio. When we're discussing beta in R squared, high beta is an aggressive stock, low beta is a defensive stock, and R squared is a percentage of variability that is market-related risk when returns are regressed on the market portfolio. Diversification increases R squared of the portfolio and decreases non-systematic risk. Alpha in the efficient markets. In efficient markets, there is no alpha, and investments earn their risk-adjusted return. Related to CAPM and the cost of capital, we have the formula for CAPM equals the risk-free rate plus beta times the difference between the expected market risk premium, actually. In CAPM, we use beta of an asset to calculate the cost of equity. Weighted average cost of capital is the discount rate based upon the capital structure of the investment. In valuing securities in efficient markets, market efficiency and the role of information in determining asset prices is important. Publicly available information should be reflected in market price. Now we're moving on to actual financial statement modeling, because we just talked about a lot of the concepts of finance that are going to be utilized in modeling perpetuities. So financial statement modeling is actually perpetuity modeling, just by a different name. Financial statement modeling refers to the creation of a standalone operating model for a company. The operating model is built using historical performance, i.e. historical financial statements or account statements. We use the operating model to see pro forma performance of a company given certain assumptions. These pro formas are the basis for decision making within the corporation. In terms of financial statement modeling best practices, we have, once again, blue for hard codes, black is for formulas. And we have to be consistent with millions and billions. We have to keep conventions the same, and we're going to show you how to do that in Excel. We have to footnote everything in the presentation and keep your models simple. 1,000 cells is better than much more. In terms of financial statement modeling steps, we first spread historical financial statements. We're going to have 3 to 5 years history for the income statement, balance sheet, and statement of cash flows. We have publicly available information received from the 10K and the 10Q. And if it's a private company, we're going to have to get audited financial statements provided by the company. We are then going to adjust for non-recurrings, and we're going to talk about what non-recurrings look like. And then we're going to end up building in cases into the operating model. And typically we have 4 cases: the best case, the base case, the worst case, and we're going to have to look at a disruption case too. The 4th step is to build assumptions based upon historical trends and assumptions in the assumptions tab, our margins and growth rates. And in the 5th step, we're going to project LIBOR and interest rates. So we're going to do the spread over LIBOR, and then the LIBOR is the base that banks use to price spread their loans to make money, called L. The 3-month LIBOR is the standard reference that we're going to be using. The 6th step is to project the income statement and the balance sheet in 2 items on the statement of cash flows, namely depreciation and amortization and CapEx before gross PP&E, on the balance sheet. And within that, we're going to have to discuss the difference between maintenance CapEx and discretionary or growth CapEx. These are going to be very important for prospective buyers of perpetuities, private equity groups, as well as strategic buyers. And then the seventh step is we're going to separate debt and interest schedule. We're going to calculate debt and interest schedule before calculating the balance sheet items for the revolver, the term loan, and unsecured debt. We're going to end up projecting working capital as the eighth step. We're going to have to find out the days payable and days receivable using the 360-day method. And then the ninth step is to project the rest of the statement of cash flows, and all the items are pulled from the income statement or the balance sheet. If AR goes up, accounts receivable goes up, we're going to need a negative sign on the statement of cash flows. And if accounts payable goes up, we're going to need a positive sign on the statement of cash flows. Balance sheet cash is the ending cash position for the statement of cash flows. The 10th step is we're going to calculate pay down drawdown for the revolver as minimum or the min function of cash flows before revolver and beginning revolver balance. And then the final step, of course, is the once the operating model is done, when you finish the statement of cash flows, the operating model check, 0 for assets minus liabilities plus owner's equity, and that's our check. And then the next step is to use the operating model for various analyses, including organic growth and inorganic growth. And the key question to ask is, what is the best strategic alternative for the corporation, i.e. how to get to a perpetuity, growing perpetuity, whatever the next phase of perpetuity is. And that ends this video. We're going to begin the next video by talking about the first side of the perpetuity, which is known as the build side.